The Internal Revenue Service and the Treasury Department have issued the final rules for required minimum distributions for beneficiaries under the 10-year rule. These changes are effective September 17, 2024. These rules affect beneficiaries of retirement accounts, mandating annual distributions with the requirement to deplete the entire account within 10 years after the original account holder's death. Hello, my name is Lisa, and I am pleased to be your AI video presenter. Today I'd like to bring you this short video with an overview of the finalized rules. If you are someone who may inherit a retirement account from a loved one, you should take time to understand RMD rules and how they could affect your inheritance. This video and related article are not intended to be financial advice, but are intended for education and entertainment purposes only. We strongly suggest you do your own research and consult a qualified financial professional before making any financial decisions. More in-depth explanations can be found on the IRS website. This information is taken from multiple sources, including the IRS, and an article by retirement planning expert Rick Sparkman, first published on safemoneytrends.com. So what are the fundamental changes and which accounts are impacted? The new regulations apply to qualified plans. They also affect Section 403(b) annuity contracts, custodial accounts, retirement income accounts, individual retirement accounts and annuities, and some eligible deferred compensation plans. The final rules reflect changes from the Secure Act and Secure 2.0 Act. Despite revisions based on public feedback, the IRS maintains that the final rules closely mirror the proposed regulations from 2022. This rule applies explicitly when the deceased IRA owner was old enough to be taking RMDs before their death. As of 2024, this age is 73, but it will rise to 75 in 2033. You may be wondering, what about spouse beneficiaries? Spouse beneficiaries retain the ability to take over the inherited retirement plan assets and treat them as their own, avoiding the annual withdrawal requirement. Also, certain beneficiaries, including those who are disabled, chronically ill, minor children of the deceased, and others not more than 10 years younger than the deceased owner, also benefit from more flexible distribution rules. Other beneficiaries, such as adult children of someone who was of RMD age, are now required to adhere to annual withdrawal rules over 10 years, with the amount determined by an IRS life expectancy table. Failure to withdraw the required amount results in a 25% penalty on the amount that should have been withdrawn. Summing it up, initially, tax professionals assumed that under the 10-year rule, beneficiaries could withdraw as little or as much as they wanted until the 10th year. However, in 2022, the IRS imposed annual withdrawal requirements, leading to confusion and a multi-year period of uncertainty. The final rules now confirm the annual withdrawal requirement. However, in recognition of the confusion caused by the regulatory changes, the IRS will not penalize beneficiaries who missed RMDs in 2021, 2022, 2023, or 2024. But be aware that starting in 2025, beneficiaries must adhere to the annual withdrawal requirements. Beneficiaries may want to consider withdrawing more than the RMD to avoid potential tax implications. Large withdrawals in the 10th year could push beneficiaries into higher tax brackets and affect other elements of their tax returns. Although these rules are final, further adjustments are expected as the IRS continues to address issues not covered by the current regulations. The IRS and Treasury are also seeking public comments on proposed regulations under the Secure 2.0 Act, indicating ongoing developments in this area. Financial institutions are beginning to offer tools to assist beneficiaries in complying with the new rules, such as IRA RMD calculators. The new RMD rules bring significant changes for beneficiaries of retirement accounts. Understanding these requirements and proactive planning will be crucial for managing inherited retirement assets effectively and avoiding compliance issues. If you need further guidance relative to your specific situation, reach out to Rick Sparkman. Contact information is below this video and at pathfinderswealth.com. Thanks so much for watching.